Hey guys, Gavin McMaster here from Options Trading IQ, and today I just wanted to shoot a little quick video and look at a stock that got absolutely crushed last week, which was HRB or H&R Block. So let's take a look. As you can see here, massive gap down on earnings, 20 odd percent on Wednesday, and then a bit of follow through on Thursday and Friday. So just absolutely getting killed. So what does this mean for us as options traders? Well, it provides opportunity for us. I'm going to show you a couple of examples. What happens, I've noticed in the past with stocks like this, when they get a big drawdown, over the next month or so, they kind of do this. They go sideways to slightly lower over the next month or so. And I'll show you a good example. From recently, we had Philip Morris back in April, massive gap down on a bad earnings announcement. And then about a month to 2 months, it goes sideways to slightly lower. Same thing happened in Target back in 2017, really bad earnings announcement, massive gap down. Momentum just continues to carry it just that little bit lower over the next month and a half. So I'm kind of expecting something similar to happen with H&R Block. And let's have a look at how we can trade that. All right, so if we wanted some exposure to the stock, we could do something simple and just sell some cash secured puts if we didn't think it was going to go down too much further. So we're currently in June. We could go out to August, or we could even go to October for a bit of a slower moving trade. So the ones I was looking at was October, the $22 puts. So we're trading at $23.50 now. We could sell those $22 puts for about $1.16. I think the midpoint's about $1.12. So let's say we sold 3 of those, and we'll change our expiry date here. You know, that's our pretty simple trade, okay? Now we'd have to come up with 3 times 2,200, or a bit less, 2,100. So a bit over $6,000 to make that trade. We're looking to make $300, so about 5%. But we've got a lot of risk on the downside, right? If we put in an interim date here, you can see if the stock continues lower, another 10% lower, we could be down $300-400. Okay, so maybe we don't want to do that. But let's just take a quick look at some numbers. If we plug that into our calculator, we've got 123 days to expiry. Strike price is 22, option price $1.12. We're trading 3 contracts. Total premium we'd bring in is 336. That's our break-even price on H&R Block. You can see that that gives us an 11% protection on the downside, which is pretty decent. Obviously, volatility is elevated in the stock, so we're getting some nice juicy premiums. And if the stock stays above 22, we get a 5% return, which over the 3 or 4 months, if we annualize that, comes out at about 15% per year, which is pretty decent, right? But as I said, I'm a little bit concerned about the follow through on the downside. So there's one way we can kind of mitigate that in the short term. Last week there was a short selling ban on the stock when it was when it had the really big down day. But what we could do, we can go in here, we'd look at our delta. Say we sold these puts, we'd have a delta of 104. Okay, so that's equivalent to owning 104 shares of the underlying stock. Now what we might do in the short term, we're a little bit worried about having positive delta on this stock. We can do something really simple and just come in here and sell some shares. We could cut our delta in half, and that gives us a nice looking payoff graph. We've still got nearly 15% now margin for error on the downside. We're not going to make as much if the stock bounces, but we're creating a nice profit zone around that, you know, 5, 6, 7% lower strike. See the interim date, we're still going to be down a little bit. Just zoom out again. If we're down 10%, we're only going to be down $150. Zoom in again here. So down 10%, about $150. Now, if we didn't short the stock, if we were down 10%, we'd be down about $275, so a little bit more. So it gives us a little bit of protection. Now, you could choose how much delta you want to reduce. You could go completely delta neutral in the trade and sell 102 shares, turns it into a bit more of a straddle kind of shape, but centered on the downside. So that's not a bad option as well. Massive margins on the downside between now and October. We can withstand a 17.5% fall and a 15% rise. And if we're down 10% in the next week or two, we are only down $40 or $50, or even less, about 20 or 30. So that's not bad. That's a little something I like to do when I see a stock that really gets crushed like that. The only issue potentially with this stock, and the only reason I might not do it on a stock like H&R Block, is the spreads are a little bit wide here. And also the volume, the option volume isn't huge on this one. So, there could be a bit of an issue with getting decent fills there. So, we'll have to play that one by ear. But, I wanted to walk you through that and show you how I look at these stocks when we get a big move like that. As I said, we've seen it before with Target and Philip Morris, and this is something that I've done in the past that has worked quite well. All right, thanks guys. I hope you enjoyed that. Just a quick video for you there. If you want to learn more, make sure you head over to optionstradingiq.com. Lots of free tutorials over there, and you can sign up for the Iron Condor course or the Butterfly course and go through some lessons there. Cool, so thanks for watching. Wish you good luck in your trading. If you have any questions, leave a comment below, shoot me an email. And if you enjoyed this video, please hit the like button, and I'll make sure to do more videos like this going forward. All right, talk to you soon.